Well, good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for 𝗧𝗶𝗱𝗲. Today is Tuesday. It is August 3rd. It's 7:30 in the morning. Don't ask me why I'm doing this 2 hours before the market opens. Probably because I can't sleep, and I'm an eager beaver. Probably qualifies. The markets are not random. They're high. They've been opening higher and trading lower, which is a first sign of a bearish move. I'm not getting overly bullish, although this is well beyond random on the Dow. On the Nasdaq, it's barely anything, and on the S&P, it's barely anything. But on the Dow, it looks like we're really bullish right now. If I had to guess, it would probably be a couple of earnings reports coming out, dragging the prices higher on the Dow. Let me get into the overall market, and then I'll give you the lowdown of why I am so fearful on the Nasdaq right now and on the overall market. We had manufacturing data. Manufacturing data is basically telling us yesterday we're slowing down in US and China. A lot of it has to do with supply chain issues, and I'll get into that when we talk about the global outlook. Today we've got factory orders, and then the next big reports come out on Thursday and Friday. Employment data, jobless claims, and international trades in goods and services. Right now, the three biggest factors driving the market is China, earnings, and COVID, all right? So now that you have like the overall broad picture, let's get into it a little deeper. European stocks opened higher Tuesday while Asian markets declined as jitters about the spread of the COVID Delta variant in China and the United States dented enthusiasm about strong corporate profits. Fear about COVID is going to overtake profits or reports about profits or any kind of news about stocks, because that's a global event and that's a lot more instrumental than individual stocks. Investors were encouraged by unexpectedly strong U.S. earnings, but are uneasy about China and about COVID, which is pretty much what I just said a minute ago. A slide in tech, industrial, raw materials, and communication companies weighted on the markets. A lot of it has to do with China, both their regulatory environment right now and the fact that they've got COVID and they're one of the biggest exporters in the world and the world's second biggest economy. Energy stocks also fell in tandem with oil prices. Remember what happened when COVID hit the first time? Energy prices fell because less production, less industrial movement, more people staying at home means less energy being used. So it's very, very normal. Gains in healthcare stocks, defensive. Pay attention to what I'm saying. This is probably the most important part of all of this. Healthcare stocks, utilities, retailers, other companies that rely on direct consumer spending. Remember the first COVID outbreak? Folks, this is part two. I'm not kidding. Monday, U.S. markets appeared to shrug off a report by the Institute of Supply Management. That's what I was talking about right here. That's this report right here. Just kind of want to connect the dots. A trade group that talked about manufacturing slowing in July. Many companies are being held back by supply chain disruptions, which is one of the stock groups I've been really harping about, is shipping stocks, packaging stocks. They are the ones that help the supply chain disruptions, and they are not very interest rate sensitive. 150 companies, we had about 200 report last week, 150 reporting this week. Then after this, it's going to be kind of trickling in smaller companies and the rest. So this is the meat and potatoes. Last week and this week is the meat and potatoes of the earnings season. Now, this is the put to call ratio. And as you can see here, it's been humpering and moving towards the level that's 0.675, 0.70. Anytime we go below 0.70, the market gets overly bullish and pulls back. This is like a rubber band going bullish, 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 bullish. And this is really, really bearish. And it moving closer to the bottoms like yesterday and bouncing off is telling me that this market is overbought and in trouble. And this is the Nasdaq 100, the top Nasdaq 100 stocks. Look at the price action moving higher, and look at my oscillator moving lower. The price action cannot sustain, the oscillator cannot sustain prices moving higher. It's telling us basically we don't recognize this as higher. We recognize this as lower on a momentum scale. And that's really, really important, because every time I see this, see divergence, it leads to corrections. And right now, we're overdue for a pullback, especially in light with the fact that if you look at the Nasdaq 100, 71% of stocks are trading above the 50-day moving average, and it looks like it's curling down. And you look at the cumulative Nasdaq, look at this, 71%, right? Look at the overall Nasdaq, 42%. Very, very, very different. So the Nasdaq 100, the tech stocks, the top 100 stocks are very, very vulnerable right now at this minute. So I want to give you guys a good hedge right now, some short trades and some long trades, because this is not a time to be a hero. As I showed you yesterday, this is the mid cap. And if you look at the mid cap, you'll see what the stock market really looks like. And it looks very different. This is really what it looks like right now. It's not in the best position ever. It's actually just kind of consolidating, moving sideways. And we can go down or we can go up. But based on what I'm seeing with the overall stock market, this is the SPY. Look at that, 2 days away from all-time highs, and then look at the equal weighted SPY. And I know I've been talking a lot about this, and I almost sound like a broken record, but look at how flat the RSP, the equal weighted SPY, is when you take away the market cap. All right, on that note, I want to talk about some stocks that I'm hating right now and some stocks that I'm liking right now. So on the bullish side, I got ABBV, ABBV, pharmaceutical. Is medical stock, right? Let me just make sure. Yeah, healthcare, large cap pharma stock. That's where you want to be. It's a defensive stock right now. Pharmaceutical stocks are not as interest rate dependent because people are going to be going to hospitals, getting sick, and getting medicine no matter if inflation goes up or down. It's pulling back from a swing high. Let's see how long of a high this is. This is a real swing high. And it's not a coincidence that these stocks are going up. It's also not overbought. It's below 50%, so it's neutral or oversold. I like this stock right now. I like it quite a bit. And it's good in light of what we're seeing right now with earnings coming out on large cap tech and overall, and in light of what we're seeing in the broad market, this the haves and the have-nots with the market cap right now. It's really wild. Now, in terms of selling stocks, I've got 2 stocks to sell. 1 stock to buy, 2 stocks to sell. This is a market where you want to have some exposure to the short side. Now, notice we're picking stocks that are very bullish and that are moving to the 50-day moving average in order to buy. The 50-day line is above the 200-day line, and it's pulling back down to the 50-day line. So, and the trend is strong. And if we were to look at stocks to sell, we would look at completely the opposite. And in this case, we have AAON. And if you look at what they do, they are in the air heating, commercial air heating. Well, if COVID heats up, do you think we're going to need commercial air heating? Do you think out of all the things we need right now, we need commercial air heating in the world with California potentially closing back up again, mask mandates going in? I think cruise lines, airlines, vacations, and commercial air heating is probably on the lower end of the scale. So now look at this. It's a strong trend. The 200-day is above the 50-day. That's the 50-day, that's the 200-day, and we're pulling back to the 50-day line. If you were to look at ABBV, it is completely the opposite. AAON, the ticker symbol, I don't know how to pronounce this. AON, I guess, AON or AAON, whatever. Notice the trend is down. We're below the 200-day moving average. The 200-day moving average is above the 50-day line. We made a swing low, and we're pulling back to the 50-day line. Very similar, but completely opposite. So that's a stock that's on my selling block, and I think it's going to hit the 58 level. One more is Reinsurance Group of America. Again, notice that the 200-day moving average is above the 50-day moving average. The 50-day moving average just crossed below. That's a bearish sign. Notice we're pulling back from a swing low. The trend has been really strong, bearish for quite some time. And I think it's going to pull back to the 104 level. And if you look long term, once it pulls back to the 104 level, it can go a little bit further. But again, we're looking at the exact same type of criteria on the way up and on the way down. Except on the way up, we're looking for the 50-day line to be above the 200-day line. And for the bearish signs, we're looking for the 50-day line to be below the 200-day line. And for the stocks to go up against the trend. These, my friends, are high probability short-term pullbacks. So we're long ABBV and we're short AAON and RGA. And it would be murderous. It would be criminal not to have exposure to the short side right now in light of what we're seeing with COVID and the market. It would be criminal. Criminal, I tell you. All right, before I let you go, I've got something important for you. Now, I'm willing to bet most traders don't know this. Massive hedge funds, institutions, banks, they're gearing up to take over the stock market with algorithmic trading, the type of trading that I specialize in. And they plan on leaving everyone else in the dust. That's right. We already had enough on our plate with rising COVID-19 cases, fragmented markets, don't get me started with all of that, and inflation. But there's still hope left for everyday investors just like you to make a killing in this market. You see, I've developed an algorithmic trading machine that investors can use without millions of dollars in upfront capital. You guys can do the exact same thing that large hedge funds are doing at home and have the same type of competitive edge. I'm not kidding. Actually, a better edge because you're nimble. You don't have millions of shares that you need to move around like hedge funds do. Are you ready to learn how you can trade against big institutions? I sure hope so. This is a winning system. It's been killing it. I think we had Moderna trade 150% last week. I mean, it's been really doing well. Click on the link below to get more information about the storm. Do it now. Make sure to like this video, subscribe to this channel if you're watching on YouTube. Folks, stay ahead of the market by being first to be notified when I post my next video giving you 3 hot picks. I mean, don't you want that kind of stuff? And leave me some feedback. support@marketgeeks.com. Would love to hear from you. Bye, guys. Support@marketgeeks.com. Follow the link. Learn about Storm. It's really, really cool, highly profitable, accurate, and it's what you need in your toolbox right now to give you that unfair advantage. Bye, guys, and I hope you're enjoying your summer because it's almost over.